Hey everybody, this is Matt at tradingparadigm.com, and today I want to discuss the three core components of a robust market system, framework, methodology, or whatever terminology you want to use to describe your approach to markets. This article and now this video were inspired by a question asked by a member within the Trading Paradigm community concerning strategies and systems. And I thought the answer was so important for every developing trader to understand that I wanted to do more than just respond privately. I wanted to share my thoughts on the subject with everyone because this is so critical to understand. Within the trading world, on blogs and in courses, forums, and chat rooms, terms like strategy and system are often used quite loosely. So I fear that most developing traders have no real clue what having a robust market methodology actually entails. To many, a strategy or system is simply a cookie-cutter chart pattern, like a double bottom, or an automatic buy and sell indicator to follow, like a moving average crossover. But to me, these things on their own are nowhere close to sufficient. Making buy and sell decisions in that type of narrow vacuum is merely a surface level approach with no sustainable edge. So I want to take this opportunity to explain from my point of view what it means to have a comprehensive trading system with real meaningful edge. This will probably be eye-opening for most because the trading space is notorious for covering up the nuances and complexities of trading with things that sound easy, like guru alert services, magical indicators, and cookie-cutter candlestick patterns. But trading is a challenging craft that requires deeper levels of market competence and trading skill in order to achieve sustainable success. So let's dive right into the three components. The first and most important component is context. Context is important because markets behave with relative consistency according to context. A lot of new traders, for example, will come across an indicator and find that it works great for a week or two, and then all of a sudden, it doesn't work so well anymore, and they have no idea why. But it's because blindly following some indicator without regard to context is inadequate. Context is king. Contextual analysis can vary a bit from trader to trader, depending on the time frame that they're operating in and their personal style. But even as a short-term active intraday trader, I still care about market structure and context on a weekly, monthly, and even yearly basis. And I typically start my analysis with the higher time frames and cascade down to intermediate and short term. The point is to understand the story that the market is telling. What's the structural narrative? Is it balanced? In other words, is it consolidating or moving sideways? Or imbalanced? In other words, is it trending or moving directionally? What's the market trying to do, and how good of a job is it doing it? What to do with this analysis can be tricky because each individual time frame isn't always in perfect alignment with the others. In fact, they're often conflicting. But your job as a trader, in order to stack the probabilities in your favor, is to take this broad, comprehensive perspective and synthesize, rank, and refine it down into high-quality trade ideas that are actionable on your time frame. I have some examples listed here of the types of things I look at and powerful questions I ask myself in order to generate a contextual read. But the goal is to identify and prioritize meaningful decision levels across timeframes and ultimately make good decisions based on what is currently happening and likely to occur next. The next core component is a more specific setup or strategy that's dictated by what we just talked about, context. I like to refer to them as playbook setups. This is a term popularized by Mike Bellafiore, one of the founders of SMB Capital, in his book titled The Playbook. But the point of building a consistent playbook is to have a set of consistent, repeatable, and dependable setups to take advantage of based on the overall context. Try to think about it in terms of a sport like football, for example. There are certain times when running plays work best, passing plays work best, and there are all sorts of different variations of those. It's a complex game with a lot of moving parts. But just like in markets, your relative success over the course of the game or the season depends on how well you handle specific situations. Did you run plays that provided your team with the highest chance of success? Were the risks you took worth the reward? It all comes down to situational fluency. There are obviously situations, certain contexts, where specific plays work best. Running the same play over and over again without regard to context is foolish, and the same applies to trading. The question I often hear asked is, does this setup or strategy work? In reference to some basic chart pattern, indicator, or something like that. And in my opinion, that's the wrong question to ask. Everything works sometimes, but never all the time. There are no certainties. But the much better, much stronger question to ask is what context, what conditions are present when certain setups and strategies work best. It's all about stacking the probabilities in your favor by aligning setup with context, which helps put yourself in a position with a real meaningful edge. I listed an example of a playbook trade and some powerful questions that I ask myself to develop and execute them. But the main goal is to categorize patterns of market behavior in varying circumstances so that you have a strong playbook that enables you to consistently take advantage of that behavior when the time is right. The third component is short-term order flow tools like time and sales, level 2, cumulative delta, and more. And there are a lot of traders who would argue that this is the most important component because order flow that's happening right now is the foundation of market movement. And I get where they're coming from on this, but in my personal opinion, especially as someone who's not just scalping for mere ticks, I'm often looking for at least something in the ballpark of a 10 to 20 point move in ES, for example. I think the first two components, context and playbook setup, are by far the most important. I use short-term order flow tools, don't get me wrong, but I have to be careful not to lose the forest through the trees. It's more of a supporting tool for further refinement. And looking at it too much, especially as a beginner, is often just a recipe for stress and frustration. Generally speaking, short-term order flow is difficult to follow and make sense of quickly enough to make good trading decisions. It moves incredibly fast and produces a lot of fakeouts. To me, it's a supplemental piece to the puzzle if and only if context and playbook setup are already aligned. Then I might use it to pinpoint a better entry and help reduce my risk. But otherwise, it's only a tiny magnification of the overall market picture. So using it as a primary decision-making tool is backwards. And again, I have some examples and questions to ask yourself in regard to order flow listed here. But what I typically use it for is to monitor for exceptional activity at key decision levels, to join and defend, and reduce risk by entering with momentum. Okay, I know that was probably a lot for many of you to take in, but how does your current market framework and trading system compare to what I've explained here? At a minimum, do you have a strong method for viewing and analyzing context? And then, are you layering reliable and repeatable playbook setups within that context? Because in my experience, most new traders don't have this kind of comprehensive system in place. Yet this is the basis for deep market competence, legitimate trading skill, and meaningful edge. I know it sounds nice. Trust me, I've been in the position where I've wanted so badly for this to be the case, but there is no holy grail price pattern or trigger that works in all conditions. That just doesn't align with the realities of the market. Good trading is nuanced and requires critical thinking and some level of discretion. Buying and selling based on generic cookie-cutter patterns and indicators alone is not the answer. I see almost every new trader go down the narrow, oversimplified route of learning basic patterns and then thinking they have the technical edge component in place. And when they implement it and experience limited or negative results, they often wrongfully assume it's an issue of mindset or psychology. And trust me, I'm a huge proponent of developing the right mindset. But being calm and patient and composed isn't going to save you from a weak methodology with zero edge. The right mindset needs to be built within and around a system with actual strength and potency. So you might want to reconsider your individual approach if it's not hitting on all three of these components, or at least the first two. You can find the link to this full article down in the description, along with various other helpful resources, and I'd love to hear your individual thoughts on this, so please share them down in the comments, and I'll talk to you in the next video. Take care.